Hello and welcome to the Green Bank Network webinar series. My name is Rob Youngs from the Coalition for Green Capital, and today we are very lucky to be joined by New York Green Bank and NYSERDA. Our guests today will be speaking about their financing and supporting of community solar projects. We'll hear more about how New York Green Bank works to finance projects and also more about NYSERDA's New York Sun initiative and how it facilitates project development and deployment in community solar. We're very excited about today's presentation. Also, I want to note that today's webinar is part of the Green Bank Network webinar series. Our next webinar in the series will be held on May 31st. That webinar will cover unlocking capital investments in energy efficiency in the C&I space, and will feature speakers from the brand new Montgomery County Green Bank and Michigan Saves. So please check out our website for more details on that. Before we kick off today's webinar, I'd like to do a bit of housekeeping. So all attendees are in listen-only mode, and we'd like you to please type any and all questions into the question window in your GoToWebinar interface. Type them in throughout the presentation. We'll be gathering the questions up, and then we will ask them at the end of the presentation during the Q&A section. And before that, I'd like to do a very brief introduction to our speakers. So today on the webinar, we have Jason Moore. Jason Moore is director at New York Green Bank on the investment and portfolio management team, where he works to accelerate the deployment of clean energy assets in New York by structuring and executing transactions for clients and business partners. Jason has a lot of experience and has helped structure renewable energy finance with developers and investors. Jason began his career in the securitization sector, spending time at BBVA Compass. He gained experience analyzing and structuring a broad range of assets in securitization, including mortgages, trade receivables, and consumer credit. We also are lucky to be joined today by Max Hearing of New York Green Bank. He's a member of the investment team, where he supports the full range of investment activities, including transaction evaluation, due diligence, and execution of scalable clean energy project investments across New York State. And finally, we're very lucky to have Max Joel, the program manager for Community Solar New York, a part of the New York Sun initiative at NYSERDA. He works to make solar power more accessible and affordable for community solar programs focused on low and moderate income customers. So we're very lucky to have this great panel with us today here. And with that, I will turn it over to our presenters.
All right. Thank you very much. Good afternoon, everybody. This is Max Joel. I'm the program manager for New York Sun at NYSERDA, and I will get us started today. So on today's agenda, I'll be giving a brief walkthrough of New York Sun, which is the state of New York's solar initiative, with a focus on our progress with community solar to date, as well as some of the challenges we've faced and how we've addressed them. I'll then turn it over to my colleagues at the New York Green Bank to do a deeper dive on community solar financing. And then finally, we'll have a So very briefly, New York Sun is a statewide solar initiative in New York. We have a deployment target of 3 gigawatts by 2023. Earlier this year, we hit 1 gigawatt deployed statewide. And our endpoint, in addition to the deployment target, is also a self-sustaining solar market. Most of the tools we bring to bear are incentives, so upfront funding for solar projects in the state of New York. However, we also support the market in other ways by providing support to local governments, consumer education, as well as some special programs for low and moderate income households. So I'll leave it at that, but I encourage everyone to visit our website at ny-sun.ny.gov. So at this point, I'll give a little more background on the state of New York's experience with community solar to date. There's a lot thrown on this slide. I'm not going to walk through this as a laundry list, but to give everyone a little bit of context, our community distributed generation policy, which is the broader regulatory framework for community solar, was approved in July 2015. So that, of course, was almost 3 years ago. To date, we've only had 15 community solar projects completed. Many of, at least the larger ones in that group, only completed in the last several months. However, we have over 300 projects currently are in our pipeline, almost 700 megawatts DC worth of projects. At this point, we're pretty confident that a large chunk of those will move forward to installation in the next 24 months. So I think there's a lot to be told in the difference between those two numbers, the massive size of our pipeline and the relatively limited number of projects that have been completed to date. So that's where the challenges come in. I'm going to touch on these at a very high level, and then again, my Green Bank colleagues, Max and Jason, will get a chance to go more in depth on the financing side. But if I could sum up the challenges we've faced with community solar to date, it's been too much of a good thing. So once the policy was approved and took effect in 2015, we had a tremendous amount of interest from solar developers in community solar in New York, and a real flood of projects entered pre-development and the initial interconnection application stages. So as noted on the slide, we had a really congested interconnection process that really wasn't designed for this sort of volume. Likewise, New York State is a home rule state, meaning that local governments have a tremendous amount of control over land use and taxation as it applies to community solar projects. So just in the same way, we had a lot of municipalities that were unfamiliar with solar, and especially large ground-mounted systems, faced with permitting and approving and developing a taxation methodology for, again, hundreds of community solar systems. On top of that, sort of in the middle of this, the growth of this pipeline, our state implemented a new compensation system for solar, especially community solar, called the Value of Distributed Energy Resources. I think the Green Bank folks will be talking about that in a little more in depth, so I won't go into detail there. And lastly, I'll just note that from the get-go, community solar was really looked at as an opportunity for lower-income New Yorkers to participate for a number of obvious reasons. You don't need to own a roof. You can go kind of month to month or year to year. But there was concern that that promise wouldn't be realized. So my colleagues and I have spent a lot of our work over the last couple of years at this point addressing with hopefully some success these challenges. So I'll just note again at a very high level that we've sort of taken this on, as we always do, with a truly extensive stakeholder process. There's a lot of moving parts, a lot of players in community solar. So we now have a much improved interconnection process in place. Part and parcel of that was increasing the size cap on individual projects, which is a real boon to solar projects, especially in upstate New York. We've really stepped up the resources and technical assistance we provide for local governments, are assisting many of them in passing solar-friendly zoning policies, putting in place payment in lieu of taxes agreements for community solar projects, for example. And then finally, in the very near future, we'll have a program called Solar for All launching that will be providing no-cost small community solar subscriptions to low-income households in New York to address some of those equity issues. So, I just ran through that very quickly. There's a tremendous number of resources on our website touching on each of these issues. But the main takeaway is that community solar has presented a huge opportunity for the solar industry and for New Yorkers who are interested in participating in solar, but it hasn't come without its challenges. When I talk to my colleagues in other states that are beginning to deploy community solar, I certainly emphasize these points. I think these are very similar challenges that, for example, Massachusetts or Minnesota has faced in similar ways. I wouldn't be surprised if Illinois, for example, started to face some of these challenges. And I think as community solar spreads nationwide, we're seeing some real best practices developed and proactive attention being paid to these issues. So one major issue I haven't talked about at all is financing, and so for that I will hand it over to Matt Sarin.
Thank you, Max. So let me start with an overview of who we are and what we're trying to do, and go into community solar in New York, community distributed generation, and our approach, and how we think it can be and become bankable. So what we are is the New York Green Bank is a $1 billion state-sponsored investment fund. We're part of NYSERDA, and really what we are is here to help, and we're looking to take your economically viable projects with a nexus to New York and figure out how to make those complete and bring them to execution. So our contacts at the back of this deck, please reach out, and hope to have some conversations here. So to move on to community solar in New York State specifically, and more broadly, Max, thank you again for the specific overview here. And some of the items that we consider are key are the ability to replace, the ability for the project sponsor to replace customers on a monthly basis, the ability for the project owner to bank and distribute unused credits in any period, and then the multiple ownership structures we're seeing in the field here, both third-party ownership and subscription-based. Subscription we've seen to be a lot more common, and a number of contract structures and off-takers, both from long-term, which we've seen a lot more often in the consumer credit side, where there's some FICO or similar underwriting. And we have that, and then we also have everything from that to short-term and everything in between. So short-term through long-term contracts, and then long-term contracts are often having lighter underwriting provisions or having optional termination provisions with little to no fee. And the off-takers for these projects are both residential and commercial. As Max mentioned, now up to 5 megawatts on the size of the project you could have for your community solar installation. And all of the power injected into the grid is allowed to be allocated virtually via these credits to the customer. And so we're now seeing an opportunity for the developer to pursue the short-term limited recourse and or floating rate structures in providing its product to the customer. And so what we're doing here in light of what Max mentioned and some of these key features of the market is taking an underwriting approach that highlights the value of the CDG program while structurally mitigating the contract or electricity price risk with the borrowing-based methodology. My colleague Jason will go into this a little more in a moment, but applying a forecast generated by an independent party based on whether those credits are monetary or volumetric, we can advance against the future value of those credits. Now, this is something that takes this community solar market with a number of complex contracts and regulations, and really helps to thread a needle in a way that we can find appropriate safety to the lender and both proceeds to sponsor and then value to the end customer. So simply, we do see a way it's bankable. We do see a light here, and we think that this is a really promising market. And at the Green Bank, it's an area we've been spending a lot of time. It's been a top priority for us over the past 3 quarters, if not even a little longer. And with this, these different structures exist to maximize value for all of our stakeholders, and I'm going to turn it over to Jason to give a little detail on the borrowing base and VDER and the value stack and how that comes into this financing.
Thank you, Max. One of the key points that Max hit on is bankability. Traditional project finance lenders look for long-term, fully contracted, fixed-rate PPAs with creditworthy counterparties, so that the cash flows over the life of the project are known and can be financed against. In the case of community solar, the compensation for the projects comes from the sale of the credits that are generated from the production of electricity. Primarily, the credits can either be net energy metering or NEM. That's a volumetric crediting process, which is being phased out in favor of the value of distributed energy resources, or VDER, VDER. VDER has a number of tranches, and each tranche over time steps down in the value that's assigned to the credits generated from VEDR projects. The value is a monetary value rather than a volumetric value. And a large component of the credit value for VEDR projects is fixed. That's the environmental component and the market transition component. So in that way, it's very similar to a long-term, fixed rate, credit value that you might know in a PPA. However, there's a variable component as well. And that's what financiers have really struggled with in terms of providing financing, that unknown component, which in the case of VEDR is the locational-based marginal price of power, as well as the capacity payments that the project receives. So what New York Green Bank has done is borrowed from successful financing models in Europe that have a variable indexed contract price that resets over time and requires that the project remain in compliance with that borrowing base. So what we've done is we've contracted with a third-party consultant to provide forecasts for the credit values. That will be the baseline that we underwrite to. And then over time, as the value of those credits increases or decreases, the borrowing base will adjust on a quarterly basis on each payment date. If the expected value of the credits increases over time versus the base case, that accrues to the equity owner as an additional return. That's the upside. The equity owner takes that. If the value of the credits is forecasted to decrease relative to the base case, then that would result in a restriction of distributions and an ultimate cash sweep to the lender in order to bring the borrowing base back into compliance. Again, that represents the downside risk to the lender. To the equity owner. So in either case, the equity owner is taking the price risk, and that's how we're going to get this financing model to be bankable, to be accepted by the market, is prove that the lender is protected from the price risk of the credits and provide a stable and known cash flow stream that can be financed against. Another key component of the as we consider how to make community solar projects financeable is the management of customers. And Max is going to tell us a little bit about the things that we consider and the things we need to understand as lenders.
Thank you, Jason. In terms of customer acquisition and management, for short-term contracts and lower credit longer term as well, or those with easy termination outs, a solution to managing customer churn and continually acquiring and allocating credits to paying subscribers is absolutely vital. The key to this is both the procedure for originating and contracting and replacing existing customers with new, and the value proposition provided to both existing and potential new customers with different types of rate structures, fixed versus floating rate, and different types of terms. A key item here is what is the basis to the utility rate, what is the savings profile of the customer, i.e. are they cash flow positive from day one, does it improve over time, and what does that basis look like to them, and how comfortable will they be today and tomorrow with their community solar subscription. And ultimately, there are many different approaches to success, but a well-developed and articulated strategy for customer churn management will lead to bankability in these projects. And all of this and more is described in our RFP 10 that we have on our website, which could be a helpful resource. And so I will turn it back over to Jason to give some remarks on some products we've had out in the market, particularly on the interconnection finance side.
Thanks, Max. And as Max just alluded to, we have been active in the community solar space over the past 12 months. Notably, that activity has taken place in support of interconnection financing. Max Joel mentioned earlier that the municipalities were kind of unprepared for the volume of community solar proposals. That led to both at the municipal level in terms of approvals, and at the program level in terms of assigning projects into feeder tranches. It created some backlogs, which Max and the rest of his team really worked hard over the past year or so to alleviate. And thankfully, we're that backlog in the queue has been alleviated to a very large extent. However, the standardized interconnection requirements that were enacted to help relieve that backlog had certain timing implications for making interconnection deposits and ultimately payments to the utilities for the interconnection upgrades required by the CESR. New York Green Bank in early 2017 executed on its first interconnection bridge loan to a developer in New York State. And all of our transactions are public, and you can read about these on our website and our transaction profiles. So you can look for the Distributed Sun interconnection bridge loan, and that'll give you a little bit more information about that transaction. We effectively financed the interconnection deposits for a portfolio of projects that allowed Distributed Sun to continue to develop those projects and ultimately secure financing elsewhere, bridging that gap between project development and project construction and ownership. We've executed on this product several more times over the past 12 months, and we are we've revised and refined our product offering, and ultimately we've come down to dividing project portfolios into two risk buckets. Projects that are fully permitted with their municipalities, with their authorities having jurisdiction. We have offered up to 90% financing of interconnection costs. And projects that have not achieved permitting and only have site control and a completed CESR, we've been able to finance the 25% deposits. So this is just one way that New York Green Bank is active in the market to try to find solutions to the capital needs and the financing barriers that developers face. Another interesting area where we could deploy a type of bridge financing would be to monetize the incentives that Max Joel's team provide for performance-based incentives, the PBIs. These are payments that the projects are eligible for if they generate a certain amount of electricity or for every kilowatt or megawatt of hour of electricity that they generate. Those are paid out, and I know that's changing, and Max is probably going to look at me and say I'm a little off here, but those are paid out over the first 3 years, at least historically they have been. And monetizing those incentives up front can be very beneficial for a project. You can either look at that on a standalone basis with a separate type of bridge financing, or in many cases, it's easier just to include those incentive payments as cash flow available for debt service in the project financing as well and roll it into one. But I do bring it up just to kind of highlight the flexibility and the innovative approach that we try to take at New York Green Bank to support deployment of clean energy in New York State. And it's really the approach that we take to community solar and all other assets that we're actively financing. And when it comes to financing, we can deploy financing in several different structures. specifically as it relates to community solar. And Max is going to tell us a little bit about those.
All right. Well, thank you very much, Jason. As you mentioned, frankly, we're here to help drive economic solutions for all interested parties in these markets. And on the slide, you'll see a couple of products that we have offered and provide value. And I'll go a little more into the project and portfolio finance side post interconnection. But would just note that these are indicative and what we found to be useful and gain some traction in terms of existing conversations, but by no means does this cover all of the potential structures out there. So if there are other ways for us to provide value, please do reach out. Please open a conversation and let's see how we can be creative in support of your products. But on the post interconnection financing side, we've taken multiple views on both to be constructed and operating community solar projects. And we're willing to monetize the value of project cash flows from existing community solar projects, and we're also willing to finance the construction to term piece where helpful and where necessary. And at the portfolio level, thinking about these projects, thinking about these assets, we can either lend directly against them, or we can do it in conjunction with tax equity. So there we can play multiple levels, generally on the senior debt side, but flexibility on our end there as well. So, as mentioned, we're a solutions-oriented team here, and happy to talk about this market and see how we can be helpful and educate everyone who's interested. So with that, we'll turn it over to Rob for a Q&A.
Well, before we do that, I would like to add one other thing to what Max just said. For our friends in the development community out there that are active in more than one state, something we are able to do at New York Green Bank is to use collateral in other states to support the redeployment of capital in New York State. So, while we are a New York State focused organization, we do routinely work with developers with a national presence, always with a tie-in to New York State, as we are a custodian of ratepayer funds, and we always deliver benefits to the ratepayer of New York State. So I just wanted to tag that on before we hand it back over to Rob.
Great, thank you so much, and great presentation. I certainly learned a lot, and we've got questions coming in here from the audience. Please continue to type your questions in here, and we'll make sure we get them to the presenters. So first question here, let me see what we've got. How does the third party that forecasts value work? Is this based on engineering and modeling of future energy markets, or something else?
Yes, Rob. This is Jason. New York Green Bank has contracted with a third-party consultant that has the expertise in evaluating both historical trends as well as future impacts on pricing, whether that's natural gas forecasts, the scheduled retirements of capacity that's operating now, transmission and distribution. They take into account kind of a holistic view of power prices and have provided forecasts with that methodology. One thing that we felt it was very important to use a third party with the expertise rather than making assumptions in-house. We strive to keep this a transparent process, and for developers and owners of projects that are actively engaged with us, we do share this information with them under NDA. But once we are working with a project owner to provide financing based on these forecasts, it's not a black box. We're completely transparent on what our consultant has done.
Yeah, I mean, and to the direct question, it's generally a blend of a time series approach based on historical data and energy scenario modeling going forward, kind of as Jason articulated.
Thank you. We've got another question here. How is the state paying for community solar subscriptions for LMI households? Maybe for Max, Joel.
Yeah, thank you. So, we could spend a lot of time on that. The name of the program is Solar for All. There'll be an RFP coming out quite soon and an accompanying webinar just for that. So I encourage everyone to keep an eye on that if you're developing community solar projects in New York State. But just very briefly, the state is going to put out an RFP for community solar projects to dedicate capacity to low-income customers. NYSERDA will contract directly with those projects and pay for that capacity. We'll also enroll low-income customers through our existing efficiency and other outreach programs, and then direct the community solar project owners to allocate small subscriptions to those subscribers. That's the very
got it. Thank you. Yeah, and actually we've got a follow-up question here. Do you, through the Solar for All program, do you provide no cost or free solar power or access to subscriptions at no cost? And if it's the former, how is that financed?
It's at no cost. So the state is paying the cost of the subscriptions because we're securing the capacity that's applying those subscriptions as part of basically a bulk procurement by the state. We're expecting very aggressive pricing from developers compared to what an individual residential off-taker could receive.
Perfect. Thank you. We've got a question here. Why have bridge loans for interconnections been so important? Are commercial investors hesitant to provide financing for this because they see the interconnection process as slow and risky? And have your investments been able to show that the interconnection phase is in fact not so risky?
Yeah, Rob, that's a great question. I think it sits more on the timing side than the risk side, to be honest. We structure our interconnection loans such that they have guarantees from the sponsor as well as project level collateral. So the equity in each project company is pledged to the lender. These projects have value. These projects, even in development, have value. We see projects trade in the market on a regular basis. Projects that are early development and late development. So from a risk perspective, we're very confident that the risk return profile is appropriate, and and we do look to be helpful to the market and providing more liquidity for these types of financings in the future. But the reason why, in my opinion, we haven't seen large traditional project finance lenders enter into this space is simply one of what they're good at and what they know, where their comfort zone is. Project finance lenders like to deploy their capital and begin construction and ultimately complete the project and operate the project and benefit from the cash flows. The interconnection process can take months, if not over a year in New York State. And traditional project finance lenders typically are not in the business of deploying capital and letting it sit on the sidelines, not building projects for an extended period of time. Because we feel like we're taking project risk here through the pledge of the project companies, and we're confident that these projects, even in the development phase, have a certain value. We're willing to come in earlier. We're willing to let our money work to support the development of these projects, to allow developers to free up this very scarce development capital that they have to use to make interconnection payments, finance it more efficiently with the debt that we provide, and use that development capital to continue to develop new projects in the state. So, I think it really comes down to timing, and there aren't a ton of lenders in the market that are accustomed to investing in this way. And at New York Green Bank, we keep an open mind, and we're flexible in what we can consider. And as long as it's a prudent investment, as long as we think that it's sufficiently supported by project collateral, we'll continue to seek to provide this type of support.
Great, thank you. Somewhat related question. Is there a statewide listing of the community solar projects that have secured interconnection, or otherwise a resource kind of showing how that has happened?
So in terms of a project-by-project listing, I do not believe that exists. As I mentioned earlier, all of our transactions are publicized on our website through our transaction profiles. So you can see the developers that we have provided interconnection financing to, and so the financing goes in support of the projects that they have developed. Beyond that, I do not know if there's a specific listing of projects.
Yeah, I'll jump in there. This is Max Joel of NYSERDA. We do have a list and a map of all community solar projects in the state on the New York Sun website. That will indicate whether they're completed or under development. It won't indicate their interconnection status. I need to confirm, but on the New York Department of Public Service website, on their distributed generation interconnection page, there is a regularly updated list of distributed generation projects in each utility territory that includes some interconnection process information. I'm not sure what level of granularity that includes, such as if they made a partial interconnection payment, a full interconnection payment, and so on. But there are some lists available.
Great, thank you. We've got another question here. Can you discuss credit risk in the community solar market? Does New York Green Bank have FICO requirements for subscribers?
Rob, thanks for the question. That's a really good one, and an important one in this market. So the way we've been doing it in these transactions is generally being market responsive to what product the developer is offering to their subscribers and what they can gain traction with. This has been a short-term contract with no or lower FICO up to a long-term contract with stringent FICO requirements that could be 680 and above, 700 and above, the same kind of standards you're seeing in residential solar to get tax equity investors involved. But the main point is, in community solar, something that goes hand in hand with the credit risk approach is the customer acquisition and management approach, because here the contracts and the credits are much more freely assignable than if you were, say, getting residential solar panels installed and bolted on your roof and you have to physically transfer them. So because credits can be reassigned and banked within a month or so turnaround, this gives the ability to, if a developer chooses to not necessarily have the same high standards for FICO thresholds as you might see in the residential solar PPA lease loan market, you would find that developer would then need to have an equally rigorous approach to their customer management and churn, and to ultimately delivering a strong value proposition to their end user, so they can either always be selling credits to paying customers or really having a proposition that won't cause many out-of-the-money events for the customers.
To follow up on that a little bit, long-term contracts with highly rated customers, that's bankable. We know that's bankable. It's done in all sorts of markets throughout this sector and others. What's less bankable right now are pools of subscribers with low or no FICO, with short-term contracts. That's less bankable. But I think an important point that Max just made is that we're going to look at the entire framework of how those credits are valued, how they're sold, and what happens in the case of a subscriber default. And we're gonna, and we don't necessarily tell a manager of a project how to run their business. We'll look at the business plan of a project manager and evaluate the specific credit exposure that a certain subscription model and contract structure indicates. So long-term fixed rate, high credit quality, very bankable, but New York Green Bank's willing to take a look at what makes sense in terms of other ways of approaching the evaluation of the consumer credit.
Great, thank you. I guess this is an obvious one. Do subscribers ever have title to a project, or is there no investment risk for them?
So, thinking I'm hearing your question correctly, I would note that there's two main structures that I'm familiar with for owning the community solar systems. One is more of an equity-based model where all of the individual subscribers take interest in the panels and then have credits allocated to their bills. And the other, which we've seen just more of from a volume perspective, is where the subscribers are allocated credits under contracts with the project sponsor who owns the project themselves or through a project company.
And the first structure that Max discussed there is the 25D structure under 25D of the code, which gives the participants in the community solar project ownership and rights to the tax benefits. The subscription model is third-party ownership.
Got it. Thank you. Follow-up question, I guess, for Max. Joel, how often is the New York Sun map of community solar projects updated?
Monthly.
Great. Another question: how does New York's system of banking credits affect the viability and bankability of projects? Some other states do not have that system.
Well, we think it's a key component. If you think about the credit risk that a project faces at any given time, in New York State, it's really only limited to 30 days because customers can be reallocated every 30 days. And if for some reason there's not a customer available to reallocate credits to, those credits are banked for up to 2 years. You have to remember that the credits in these projects are the value. Selling the credits generates the cash flow. So the ability to not lose that cash flow, if there is a distress scenario where customers are not being replaced, that's huge from a financing perspective because there's 2 years to figure out how to monetize the credits that have been generated and not allocated.
Got it. Thank you. A follow-up question on Jason's customer subscription diligence. Could you talk about other factors you look at besides FICO and contract length? For example, management practices, wait list size, and also any other best practices you wish you saw more of in the market.
I guess I'll hit on two things there. One thing, if you're looking at a pool of subscribers that, let's say that we're not requiring FICO scores for, we are going to want to see some evidence of creditworthiness, specifically as it relates to payment of utility bills. So, we might require 12 or 24 months of clean, utility bill payment for those types of customers. So that's one way of taking an alternative approach that could scope in more low FICO customers, because there are certainly people with low credit scores that are reliable payers of their electricity bill. Another thing that you mentioned, Rob, the wait listing. What we refer to that as flex capacity, where it's twofold. You can have a pool of subscribers that are allocated maybe up to 75% of their usage in credits. That way, if a customer does default and they are removed from the allocation next month, there's all the other subscribers have up to 25% of capacity that can absorb that reallocation of credits. So that's one way to kind of build in a flex capacity. Another way is just have a wait list, where you have your credits subscribed at 105%, or 102%, or 110%. It allows for confidence that customers can be replaced. So if you're in a model where you are providing 100% offset of a customer's utility bill, we would certainly view the flex capacity provided by a waiting list as a credit positive.
Perfect. Thank you. Great. We've got another question here. Do projects have to show a concrete plan to manage customer churn based on guidelines from New York Green Bank or anyone else? Is this mainly based on getting the price/value proposition right for the customer?
So managing customers in general is a key component of any type of financing that touches consumer finance. And this is no different. You see it in the residential PPA market. You see it in other forms of consumer finance as well. Specifically managing customer churn. It's important for a lender to understand how that will be done. In community solar, it's an unknown right now. We can look at models from other industries, the telecom space, for instance, and look at customer churn on cell phone contracts, for instance, and kind of see what that is. We can look at data provided by the U.S. Census Bureau on how often people move. There are a number of metrics at this point you can make some good assumptions around and come up with an idea of what churn might be. But the reality is we're not going to know how this market behaves until it actually operates. And to that end, it's important for a lender to have faith that the manager of the project either has the in-house capabilities to manage that customer churn, to provide billing and collection services, to acquire new customers, to resolve disputes through call centers or other customer service. And if the owner of the project, manager of the project, doesn't have those capabilities in-house, there are a number of service providers that could be used to get a lender comfortable with the ability of the project to maintain its customer base.
Perfect. Thank you.
And just to follow up a little bit on that comment, it's a piece of the puzzle, It's a key one, but it's a piece of the puzzle. So if there's really strong credit profiles that are going to lead to perhaps a lower churn rate, that's something that's taken into consideration. But at the end of the day, in a financing, it's a real key to unlocking the value and knowing that there's an articulated customer acquisition and management strategy in place, something that's ready to go should there be a large amount of churn, and that there's a backlog so the sponsor can be able to fill that with little interruption of service and continue to deliver value.
Got it. Got another question to all presenters. How has community solar been received by customers in New York? Are projects quickly subscribed up front?
Max, Joel might be able to speak a little better to this, but of the projects that I'm aware of that are operating, there has not been much challenge in finding subscribers for those. One thing to realize is that by regulation, the supply of community solar is constrained. That was done by design, not to flood the market with community solar, to make it to deploy it in an orderly manner. Not everyone is going to be able to secure a subscription. So if you believe the premise that community solar will save money for the consumer while providing a positive environmental impact as well, that makes it a pretty attractive product. And I expect for demand for community solar subscriptions to outpace supply.
Great. Thank you. We've got another question here. You covered this a little bit, but maybe a little more detail. Your role in advancing community solar today has been focused on providing interconnection bridge loans. Do you see New York Green Bank providing more of these types of loans, or evolving to provide some other sort of financing to advance the community distributed generation market?
So our efforts to date, I wouldn't say they've been focused on providing interconnection bridge loans. We've been focused at supporting the community solar market. What has been executed on to date is the interconnection financing. That's because that's earlier in the process. So that's just a natural output of the efforts. The first things to happen have been the interconnection financings. But taking a step back to a bigger picture, we look to support the market wherever we're needed. If there is a continued need for interconnection financing, New York Green Bank will be here to fill that financing gap. We strongly believe that the term financing, the back leverage, or the project financing of community solar portfolios, we believe that there will be gaps there in the financing of those, and we're here to fill those gaps as well. Ultimately, we would like to deploy financing structures that private lenders are comfortable with, where initially they might want to come in alongside New York Green Bank in financing some of these portfolios, and ultimately have the private sector take over all the financing. And then New York Green Bank can move on to new areas where gaps might exist, whether that's solar plus storage, whether that's energy efficiency, electric vehicle infrastructure, offshore wind, any number of things that we see as being the next frontier of financing renewable energy and energy efficiency infrastructure, sustainable infrastructure, for the benefit of the ratepayers. I think one thing that's particularly interesting, Governor Cuomo has made several announcements over the past few months. one being a focus on battery storage. He, recently announced in the State of the State that New York Green Bank would be supporting up to $200 million of battery storage. And, we would love it if that number was much greater than 200 million. But we do, but the point is, we are in a state where there is tremendous policy support and tremendous political support for deploying these technologies. At a time when there's been a pullback at the federal level, we think we are uniquely positioned to take a leadership role and provide capital where capital is needed.
Well, excellent. Thank you so much. And I think we're at the hour, so I think we'll wrap it up at that. And there was another question on other markets you're focusing on, so you nicely answered that question as well. So well done. And I'd like to thank everyone for the great presentation. Thank you to our speakers. Thank you for the audience for a really active participation and some really good questions. I think we all learned a lot here. And just FYI, the webinar was recorded and will be posted on the Green Bank Network website. So please check back for that. And to keep up to date on any upcoming webinars, events, et cetera, please sign up for the Green Bank Network newsletter and follow us on Twitter. And I'm sure New York Green Bank would appreciate the same for their webinars, and they keep a pretty active presence online as well. So with that, I'd like to say thank you to everyone, and we'll sign off there. Thanks so much.
Absolutely. Thanks, Rob, and thanks so much for taking the time. Everyone appreciate listening in, and it's just as easy as picking up the phone. So get in touch with us, and look forward to speaking with you.
Thanks, everyone. Take care.